When it comes to investing, retirement, taxes, healthcare, and estate planning, the decisions you make today can greatly affect the quality of life for you and your loved ones tomorrow. What you need is straight and unbiased information on the most important issues you'll face when planning for your retirement and financial future. Good news, you found Premier Retirement Radio with Jeff Vogan. Jeff is the founder of Premier Retirement Planning and Wealth Management, and he's been guiding people financially and into retirement for 30 years. So get ready for an hour of the most comprehensive financial information on the radio. Premier Retirement with Jeff Vogan. And now here's Jeff Vogan and Jeff Shea.
Thank you so much. Welcome to Premier Retirement with Jeff Vogan, the radio show that gives you the straight talk and honest answers you need to help you reach your wealth management and retirement goals through smart investing and careful planning. On today's show, we're going to be talking about volatility rates and retirement, what you should do now. We'll answer listener questions and finally, retirement mistakes that you'll regret forever and how to avoid them. My name is Jeff Shea. As always, I'm just here to ask the questions, but the words of wisdom and solid advice, they come from the other Jeff in this radio program. Of course, it is Jeff Vogan, founder and president of Premier Retirement Planning and Wealth Management. Jeff, how you doing today?
I'm doing great. How are you doing?
I'm doing fantastic, thank you. Now that we're talking together on the radio, hope everybody else is having a great weekend here in Tucson, Arizona. Jeff, retirees are hearing about market volatility, tariffs, slower growth, and interest rates staying higher at a high level. How do you think retirees should interpret all of this noise, things like the Dow at 50,000?
I mean, it is just really noise. I mean, Dow at 50,000 only matters if you have those 30 stocks. And if you bought it below that, I mean, there's only 30 stocks in the Dow, and it basically is an index that has a piece of each different industry. So it gives an overall viewpoint on how people are investing. It doesn't necessarily mean the economy's good. It doesn't necessarily mean the stocks are going to continue to go to the moon. It's just another thing. If you look at the market, or if you look at the typical historical returns in the stock market, the Dow or any index should double roughly every 7 to 10 years. And that's just to give you a 7 to 10% compounding interest rate. So at 10%, it's going to double every 7 years. So 7 years ago, the Dow was around 25,000 and 50,000 seems so far off. It really isn't. If you think about 100,000 on the Dow, it doesn't seem that far off either. It'll be mid-2030s, we'll probably be hitting it. I don't know if it will get there any sooner than that. We'd have to create a lot more liquidity and probably manipulate the market a lot more. Right now, the market's high. I think the next decade, you might find that we go back to those averages because I think we're a little ahead of ourselves right now. It doesn't mean 7 to 10 years the market will be at 100,000, but on average over time, it could be. I think if we go back to where the market is fairly valued, maybe 40,000, maybe in 10 years, the Dow will be around 80, which would give us about a 60% growth rate over the next 10 years, 5 or 6% per year, maybe. If you look at some of the overvaluation statistics, like the Shiller Index and the Warren Buffett indicator, which calculates the difference between the GDP versus the Wilshire 5000, basically the stock market versus the GDP, and what that ratio is. Warren Buffett thinks this has been overvalued for several years, and he's been going to cash for several years. I mean, he's got more than a third of his Berkshire Hathaway $1 trillion portfolio in cash waiting for a correction because it's inevitable in his mind. And I think it is inevitable in everybody's mind who watches the stock market and learns anything about history or has invested for very long. So the Dow hitting 50,000 is just another benchmark. Okay, it's a good round number. It's cool. 50 is a nice number. 100 is a nice number. 10,000 points is a good number. It still doesn't mean, because the Dow hits 50,000 or 60,000 or 40,000, that, oh my gosh, it should be a call to invest. I think a call to invest is you look at the market, you look at what your long-term goals are, you look for your short-term goals are. If it's short-term goals and the market's overvalued, probably not a place to put brand new money if you want to use it soon. If it's something that you're going to start investing in over the next 10 or 20 or 30 years, then why don't you just start investing systematically like most people did back in their 20s and 30s in their 401ks and things that now have $1 million or more in their 401k. Again, I don't think the Dow hitting 50 is anything more than noise or just kind of a call to get people excited and get people emotionally stirred to put more money in the market. It's Wall Street's call to action, and they love everybody buying because that means their portfolios go up. It means their pension funds that they manage, their hedge funds that they manage, and their mutual funds, everything else looks good and makes life look rosy to them. And of course, they're making fees based on the values of those things. So, yeah, I think the market is what the market is. The market is by and large manipulated. It's now driven by algorithms and AI as much as anything. It's also driven to work against the psyche and emotions of the average Main Street investor. And there's more Main Street investors than ever before. More than 60% of households own stocks. And that's a high that isn't really seen very often. And when that happens, typically the market's overvalued. And it's really because institutions are loving to sell their storehouses of stocks and investments at a premium to people that are not considered smart money. The Main Street investor doesn't have all the information that the Wall Street does. And we're seeing a lot more selling from the inside, meaning from CEOs, from Wall Street executives and so forth, than we're seeing buys. In fact, very few companies are net buyers. When I find one, I jump on that stock. It's usually a stock that goes into our portfolio because it means the people that know more about their company are more interested in buying their stock than selling, meaning they have high hopes, they have new contracts on the horizon, they have a niche in the market that isn't recession or stock market proof perhaps, or correlated to the stock market or any crash coming. And so there's some things that we always have to watch being on the inside of the market, meaning in the market and watching the market and buying a ton of information like we do to keep up on the market so we can be good managers and good stewards of people's money. Now, having said that, I still think if somebody is making every investment decision based on when the Dow hits 5,000 or 50,000 or 100,000, or when the S&P is going to hit 7 or stay above 7 or hit 8 or 9 or 10, I mean, it's inevitable those numbers are going to happen because over time, the prices of those things just go up, investments go up. Unless they do a reset or maybe a 10-to-1 split or something and start those indexes back down. Maybe they do a 10-to-1 split on the Dow and call it 5,000 because it's more in line with what the S&P is and the thousands, not the tens of thousands. But then again, sometimes it's kind of fun to have a different index with different values so you can easily tell what index you're talking about, what index you're looking at, and maybe it's easier to manage. We don't look at necessarily the indexes. We look at some of the stock market fundamentals. What we do like about when we do see the indexes going up, if we look at volume, and volume is increasing because there are actually more buys creating these indexes to go up, that means the market, not the economy, but the market is maybe a little healthier than not healthy. Even though the market's overvalued doesn't mean the trend isn't up. We have seen a lot of days, however, that the market can actually go up, but the volume is really not there to support it. It's either very thin trading, very limited, maybe only 1 or 2 stocks in the index have a lot of buys. But you've got some big stocks like you've got Microsoft, Palantir, and some of these stocks that have really driven the economy and driven the tech market the last few years that are plummeting, that they're horrible buys right now. In fact, they're just coming out, oh, maybe we should short them. Well, I think the short opportunity is over. In other words, they've gone down quite a bit. But some of the stocks that were driving the market a year or two ago are no longer driving the market. And we have to just kind of consider each investment individually, or you just say, I don't want to consider the investments individually. I don't want to hire an advisor to help me pick those investments. I'd rather just do it on my own and just park it in the index and hope over the long haul it makes money. And over the long haul, historically, it has made money. But over short terms and short periods of time, like 2000 and 2008, there's been some horrific crashes that have devastated some people financially and some people that just retired. I have a story about Norm I tell so often. If you listen to the show long, you've heard it several times. But it's really the epitome of bad timing in the market and having all your eggs in one basket, having all your eggs at risk. If the market plummets and market crashes, you could either have to readjust your spending habits in retirement, go get a new job, start Social Security early, and do all those other things that are retirement derailment rather than retirement control, retiring on your terms, having that peace of mind and confidence that you're going to be able to retire, not run out of money. So I kind of deviated a little bit from the Dow hitting 50,000. My answer is, yeah, so just another day, not just another number. It doesn't mean it's going to go down tomorrow. I think it's funny because this year, I don't know how many new highs all the index have made, but there's been several new highs, recurring new highs on the indexes this year. But year to date, all the indexes are down. So what are we celebrating? So what? It made a bunch of new highs, but you can make a new high with 1 point over the last high. And then tomorrow the Dow could fall 800 points like it did earlier this week. So it's all relative. What you get one day can be taken away and then some another day. So, you know, if we just look at the year-to-date indexes, the NASDAQ's down 2, S&P's right at break even. The Dow's just a little bit over 1% actually. So they're not down, but I mean, they're not knocking the cover off the ball here. And if you combine all the indexes between the three, you're flat to a little bit down. So has it really made any money? It's created all these new highs. Does that mean the market's going to the moon? That just means it created a new high. So we have to keep that in perspective. We also have to keep track of what are we doing in the market? Are we in the market because we are a long-term investor and we're just going to buy and hold until we retire 20, 30 years from now? Or are we retiring next month and we need to take some of those profits off the table? I think when we see a bunch of new highs getting hit, but the market overall really isn't moving up or trending up for a relatively long period of time, not long as in long-term investing, but over the last couple months, we really haven't had this robust growth that Trump likes to brag about, really hasn't come back to the market and made anything go to the moon or knock the cover off the ball, so to speak. So take it for what it is. The stock market is a crazy place. It's a ruthless place to invest because there's forces that are much bigger than all of us playing against us, controlling it. So we just have to know when to get on the bus and get off the bus at the right time, and we can take a nice ride. But if we stay on the bus till they crash the bus because somehow it's in their best interest, the market will do what the market does, and Wall Street will play the games that they need to play to win. And even when the market crashes, it seems interesting how Wall Street finds a way to win. And many consumers, normal people, retirees, average Joes, Main Street USA doesn't win in some of those cases unless they take action to protect, preserve their life's work, and to create income plans, create tax efficient income plans, to create investments that aren't, any risky investment isn't needed for monthly income, and that those things that are needed for income are principal protected. So again, that's why we promote a comprehensive plan, look at all the aspects of it. It's not just, oh, come here and buy something, or, hey, let's see how good Jeff's portfolios are doing. Our portfolios are doing great. Our portfolios are beating the market, but it doesn't mean you should have all your money in them, because we can't make that promise forever. We can't say that we're not going to get hammered with the market in the next crash. Now we're going to do everything we can to avoid it or to minimize any damage, but there's just no guarantees in the market. So we have to be careful. And that's why we're more comfortable risking clients' money if it's a small amount, or it's an amount that can be afforded to risk or could be allowed to reset or recover before it's likely going to be needed. Again, those are just my thoughts. When people get a little bit overly exuberant just by seeing a new high in the market.
Talking with Jeff Vogan of Premier Retirement Planning and Wealth Management here in Tucson about volatility rates and retirement, what you should do right now. Jeff, continuing this conversation, for years, bonds paid almost nothing. Now the rates are higher. Do you think that fixed income is becoming attractive again for investors?
I don't know. I think fixed income, I don't necessarily like fixed income from the standpoint of Wall Street calls it fixed income bonds. Bonds are, been trashed the last few years. And I don't know if they're going to come back. I mean, they should. If interest rates really do go down, it might be a problem, but it might not be. Sometimes people can invest in fixed income annuities. I think those are a lot more safe. They're more guaranteed. You don't risk the principal. You let the insurance company do that for you. Wall Street doesn't like those. Fixed income, meaning some people like to use dividend stocks and call that fixed income. But if companies start losing money, they lower their dividend. I remember AT&T over a 5-year period lost as much as their whole dividend was. So basically you were break even and a little bit less just to basically they were given all their profits and all their stock gains were given to you in dividends. So did you really make money? No, you couldn't even get out of that stock. Well, I could hold it forever and it'll come back. Well, maybe it will, maybe it won't. That's the thing. And if you chase dividends, you got to realize that dividend stocks do go up and down. And you might, if you ever have to cash those in to live or to pay a bill or something, then that's not necessarily a good income plan. The other thing is so many people say, oh, I have this dividend stock. It's really a good blue chip and it pays a 2.3% dividend. I don't really like a 2.3% dividend. I'd rather invest in a growth stock that has a potential to grow 10 or 20% and invest my safe money in something that pays a 5 or 6% guaranteed rate of return and is principal protected. Because unlike bonds, insurance companies will buy bonds, but they'll give you a good interest rate. Right now, we can get accounts that will guarantee 5% and guarantee that your money is going to be worth exactly what you start with in 5 years. And they'll still pay you 5%. And if you don't want to use the cash, you can defer it and it's tax deferred. So there's some advantages to using insured products for income. I like them. I like the indexed annuities, which are also income focused. And so if you wanted to split up a Wall Street portfolio into different buckets, I would definitely use the insured bucket, the insured, secured, principal protected bucket, because they always provide more guaranteed income. I can use the word guaranteed on them. We can guarantee the income. I can show you if the principal is guaranteed or if the principal is sheltered from loss, or the principal could be guaranteed, but if somehow you spend the principal in some of these annuities, they'll continue to pay you even when the balance is gone. And if you die before the balance is gone, your heirs get the balance. So it's not like some of these old school annuities have given annuities a bad name. So fixed income is not dead. I think fixed income, in my opinion, using bonds or dividend stocks is. I haven't really liked them for a long time when I finally did the math on income producing annuities, because it's better. It works better in the client's favor. You can risk less money in more aggressive return stocks if you have more of your money in guaranteed fixed income products, not associated with Wall Street and risk. Even bonds have risk. We've learned that. I mean, what's a 20-year bond down? Still 30 or 40% below its high 3 or 4 years ago. It's got a long ways to go to catch back up. It's got about a 50% or 60% return to be back in the realm of what it used to be. But then again, in order for it to be that high, interest rates are going to have to go back down to zero. Are they going to go back down to zero? Honestly, I hope not. I think that's kind of an unhealthy rate. It stimulates the economy by giving people easy access to money. But we've seen what it did to inflation in the year 2022 and 2023. We had crazy inflation, went through the moon, right? Or 21 and 22 maybe. And then the market crashed to try to correct it because the Fed had to raise interest rates to start curbing the liquidity or try to make it harder. But then what happened? The rich got richer and the poor got poorer. Now the poor can't afford food and rent, and the rich made more interest on their money. The stock market was continually manipulated, and those people that had money continued to get richer. And it's unfortunate to see the separation of classes because of, I think, bad government management that focuses more on the rich and wealthy, the people that get them elected and give them campaign contributions, rather than the middle-class person that really is the heartbeat of America. So I don't know what to do to change that other than voting better leaders, but who knows how we can do that. Bottom line is fixed income can be done in a variety of different ways. I don't think the Wall Street method Wall Street really isn't an income generating place. They have bad rules of thumb. I mean, 4% rule is all they say you should be able to take out of a stock and bond portfolio, when a person who's retired can take 6 to 10% rate of return on their investments without any risk of losing that income for the rest of their life, and also without any risk to their principal. And if it doesn't grow as much as projected and it runs out, you still get the income. If it grows more than projected or even close to projected, then there's a balance due for your heirs. So different ways to skin the cat. I don't think fixed income, even though people are returning the bonds because they pay higher interest, I don't know how long that interest will last. I think if you lock in good interest now, you'll probably be happy because those bonds will actually increase in value. So that might be a play, but it would be more of a play to add to, one of your risk portfolios, even though it generates some interest. We have income portfolios that are securities related, and they do pretty well. We have really high dividends, high interest. We trade out of those stocks or those investments if they start heading down or getting a downtrend. But we try to at least get those ones that are stable, that are holding their value, and that are paying decent returns. It's a more liquid way to have income, but I wouldn't put all your income plan to that particular strategy. It's just one part of many buckets in a strategy to make sure your income lasts, your taxes are minimized, and that you don't have to worry in retirement where the next paycheck or the next month's bills are going to come from.
Good points there, Jeff. Folks, if this conversation made you realize you're not quite sure how your retirement plan would hold up in this kind of market, that's exactly why Premier Retirement is here. We specialize in retirement planning, not just growing money, but turning it into dependable income that lasts. So call us today at 520-780-9059 to schedule your complimentary Premier Retirement Roadmap Review. There's no cost and no obligation. You're going to be walking away knowing whether or not your plan is built to survive volatility, inflation, and a 25 to 35-year retirement. Once again, the number is 520-780-9059. Now, there's no cost for this, and there is no obligation whatsoever. It is entirely complimentary. Don't leave your retirement to chance. Get some clarity. Get some confidence. Get a plan at Premier Retirement, 520-780-9059. We would love to help you out. Jeff, getting back to our conversation here, should you invest when the market is at an all-time high like it is today?
Well, again, it depends on your strategy. I kind of touched on that earlier when you asked about the Dow reaching its 50,000 or hitting its all-time highs. I think it's more noise than a call to action if you haven't started investing. I think if the Dow continues to go up and if it inspires people to continue to put money in it and create more volume, then the market's solid and it still has some uptrends. A lot of stocks are actually good to buy when they make new highs because there's just a certain momentum factor that happens when a stock makes a new high. Especially if the trend is up. Sometimes you get higher highs and higher lows. If that's kind of a trend, then every time it makes a new high, we might be turning over to make a new low, but the trend is still up. It's still a good time to buy. I don't know that just because it's hitting all-time highs, it's a time to buy. I think you still have to look at the fundamentals of the market because every market crash that's ever happened in history came after a new market record high. They always did. So it's not like, oh, it made a new high, so we're not going to ever have the crash. Or, oh, it made another new high, so we really aren't in bad shape. Or, oh, we're really not overvalued. Look, the market keeps making new highs. Well, if it doesn't keep making new highs, then it's either flat or going down. So is the trend up just because it's making new highs? Generally speaking, yeah, but it could look a little flat like it has the last couple of months. It hits a new high, then it backs off, hits a new high, backs off. And we see some pretty big volatile sell-off days every time something weird happens on the news, like the tariff thing. At first, it was like, oh, they're going to decrease the tariffs. They can't do tariffs. Supreme Court says he can't do the tariffs. Well, under different acts of different powers, he can. And so for a minute, the market felt relieved. And then after that, I was like, oh no, the market, he can actually create more tariffs. This is scary. But we really haven't seen tariffs in general hurt the market. They've actually created a lot more income. And for most small businesses that are based here in America, it's actually created more earnings. And we've seen the Russell 2000, which is mostly smaller cap stocks, smaller businesses, many of them more local businesses, not worldwide businesses that are showing better earnings than they have in several years. So the earnings on those alone means that tariffs are working to help make America stronger and maybe ticks off a few of the foreign countries. But if you look at the foreign emerging markets, if you look at foreign stocks in general, their stock markets are rebounding nicely after COVID, and there's still some strength in some of these countries in Europe and Asia. We're seeing some strength. So it doesn't seem to really be damaging those other economies, because the fact is that we're still buying their goods. Just the fact that maybe we're buying less of them, maybe they have to mark them up a little bit in order to cover the tariffs. Oh, well, they're still making their money. They're still growing. Their stocks are still getting better. So are ours. So it's kind of like what Trump said, is kind of balancing out the business in general and taking away a lot of our disadvantages and maybe muting a little bit the foreign advantage of sending bulk products into our country at cheap, can't match prices. It puts a lot of our own companies out of business. And I think if you look back at history, I don't know, it seems like the cabal, all these people that manage the world, the Rothschilds and the big money people, Soros was involved in all that stuff too, is they like world control and domination because they have so much money. And I don't know, I think defunding America by making incentives to move industry out of America has been kind of part of that one world order long-term plan. I'm not trying to sound like a conspiracy theorist, but there's a lot of powerful people worldwide that like the idea that we're not as strong as we used to be, that our economic indicators for several years are going down, not up, that our economy is getting weaker, basically more mainstream with the rest of the world rather than dominant like it has been for so many decades and even centuries now. So yeah, I think we have to look at where the market is, where the economy is, the fact that there are some things happening that are making America stronger that might support the market for a little longer. I think we're overvalued. I've said that. I think some of the softness we've seen in the market lately and some of the fact that sometimes we have sell-offs for no reason other than profit taking or maybe fear. We see defensive stocks like consumer goods, the Procter & Gamble's and the Coca-Colas and some of those things that seem to be a little bit more stable because nobody's ever going to stop drinking Coke, even if there is a recession, for example. We're seeing some of those stocks as defensive plays start doing well. The Walmart, some of the basic nuts and bolts of the economy type stocks are getting some traction, while some of the techs and the overvalued AIs and some of the speculative AI type stocks that don't have proof of growth or don't have continuing solid earnings and niches where they can dominate, those other stocks are not tanking, but actually some of them are not doing that well. There's only a handful of stocks that are still on that ride upwards and kind of propping up the market to a certain degree, or we'd probably see a lot more negatives, especially in the NASDAQ. Basically, the NASDAQ index, the Invesco ETF that everybody follows, rise right along with the NASDAQ, which is mostly tech stocks and things that are, I think, a lot more economically sensitive, interest rate sensitive. And when we see those things kind of give us some market information, it gives us a little bit of indications as where the market's going or where the mindset of the big investors, the institutional investor are, then we can decide, I guess, whether or not we want to jump on the index and ride or jump in the market and ride. But I think right now is you got to be very picky about the investments that you make just based on what I'm observing. And just because the index goes up, it might be just a couple of stocks in that index that are making it go up. For example, the Magnificent Seven, made up like 90% of the earnings for the last couple of years, and now they're not. The Magnificent Seven's the weak seven, and some of the other stocks that have been kind of forgotten and on the back shelf are now coming back into play. So, yeah, I don't have a crystal ball. It's not a thing where if the market makes a new high, it's time to get in. It's just if a market makes a new high and you're in it, then you say, oh, good, we're still going the right direction and we haven't had any crash or anything to be super scared about. But I think you always need to have you have to have a large respect for the market, and you have to have a slight, I guess, aversion to it if you are not in a position to lose money. So you have to be very careful, and when you're walking in dangerous places, and if you have only so much money and you've quit your job and you need income, then I think we don't just chase indexes. We invest responsibly, diversify across different types of assets, not just those ones that go up with the market, but also those ones that don't go down when the market goes down. Principal protection is important. Income is important. High interest rates are nice to lock in at these rates right now. We can lock them in for longer terms, especially if there is a recession or a market correction. Typically, the Fed will drop interest rates to try to curb the damage and to get us back on track. So we might see interest rates lower just because Trump's putting a lot of pressure on the new Fed chair and so forth, but we might also see that a recession requires it. So again, I think right now is a great time to take advantage of some of the higher interest rates that we haven't seen in a long time, but not to get too euphoric about the fact that the market makes new highs. We still have to respect that and be careful.
Jeff, good insight on that. Appreciate the answer to that question. Folks, here's the bottom line. Markets hit new highs because over time, businesses grow, innovation continues, and economies expand. If you're sitting in cash because you're nervous, you're not alone. But history is clear. Avoiding the markets at an all-time high has cost investors significant long-term wealth. If you'd like help building a disciplined retirement plan that isn't driven by headlines or fear, Jeff and the team here at Premier Retirement are here to help you. So reach out, have a conversation. Make sure your money is positioned for your long-term goals and not short-term emotions. Call 520-780-9059. You can make that call right now if you want. Leave your name, telephone number. Shelley will return the call and set you up with Jeff and an appointment so that you can discuss your needs and your concerns. It's 520-780-9059. Remember, there is no cost and there is no obligation. We'd love to talk to you. 520-780-9059 or online at primrat.com. Jeff, time for a break. When we come back, we've got listener questions and more when Premier Retirement continues here on 790 KNST, Tucson's most stimulating talk.
You can't start a trip you've never taken without a plan, and you can't start your retirement journey without a comprehensive plan to get there safely. To request your no-cost Premier Retirement Roadmap, call 580-780-9059 or request it online at premret.com. Now back to more Premier Retirement with Jeff Vogan and Jeff Shea.
Thanks so much for joining us here for Premier Retirement on 790 KNST, Tucson's most stimulating talk. We're on the air for you 4 times a week on terrestrial radio, Saturdays at 7 a.m., 9 a.m., and 1 p.m. Also at Sundays at 11 a.m. We're also a podcast. Go to wherever you get your podcast, search for Premier Retirement with Jeff Vogan. You're going to find this show and all of our past shows so you can stay on top of your journey towards a confident retirement. Once again, we invite you to call us at 520-780-9059 if you heard anything on the program today that you have further questions about, or you want to just sit in and talk to Jeff personally with your individual concerns. We invite you to do that at no cost and no obligation. Again, it's 520-780-9059. You can make that call right now if you want on this Saturday or Sunday. Leave your name, telephone number. It's not going to cost you a dime, totally complimentary. 520-780-9059 or online at primrat.com. Okay, Jeff, time for listener questions this week. Gary kicks us off in Tucson. Gary says, I'm 80 years old and I need to get my financial ducks in a row. I have $850,000 in investments, $350,000 in life insurance, and about $500,000 in equity in my home for a total of $850,000. Plus, he says he has a good long-term care insurance plan. All this is going to go to my son. What's the best way to protect him from heavy taxes when he inherits?
Well, a lot of things are going to be stepped up in basis, like your home, any non-IRA assets. Now, if you have IRA assets that are deferred, your son's going to get a tax. And as far as your asset size goes, you're not going to have any estate taxes or any inheritance taxes that are levied by Arizona, but you've always got the deferred taxes that you haven't paid for. So the life insurance is tax-free. It's not going to be an estate tax. The home's going to get a step. So you got about $850 in total assets. I don't think there is anything unless you have other things that you haven't told me. So there's no heavy taxes that I see. If you have 401k or IRA, then that'll be taxed, but you could always systematically convert that to a Roth, or if you're at a lower tax bracket, just take it out, pay taxes on it, reinvest it, or pre-inherit your grandkids or something and send them on trips or help pay for their college or something, or down payment on a house. I mean, you could do that. I would say just look at your overall situation. I'm assuming that if these assets, you're kind of leaving the life insurance, I'm guessing, for the tax-free death benefit, might also cover you for long-term care, some sort of accelerated benefit if you get sick. So you're not going to use that for distributions at this point, I don't think. I'm guessing you have good income or good enough income that you have enough to pay all your bills and maybe a surplus. If you don't have a surplus, then I guess that life insurance would be available. You could also do a reverse mortgage on your home and actually borrow from that equity if you needed extra cash. But if you've told me the whole story and this is the only 2 assets you have, then there is no tax problem. If you have more things, then we probably ought to discuss those. And again, if they're tax deferred, the tax deferral aspect will pass on to your heirs.
Gary, good question. Thanks for listening to us in Tucson. And of course, if you want to further this conversation with Jeff, 520-780-9059 is the number. You can make that call right now and set up that appointment. Okay, Jeff, next question. John's in Dove Mountain, and John says, I'll be 73 in a month, and I have a question about RMDs. How should I take them? Annually, monthly, or quarterly? Is there any advantage of one method versus the others?
Not really. I have a theory about RMDs. Most people don't really like them. They're kind of like, oh, no, I have to take this because by the time you're 73, you've already learned to live on your budget, probably aren't taking money out of that IRA if that's what you're asking. I like taking them as Christmas money because here's the thing. If you start taking them, well, I guess you could take them annually, monthly, quarterly, whenever you want to, but they sit and grow in your account longer if you just leave them in there longer. If you want them monthly, and that's fine too. The thing is, though, you have to withhold enough from those not to get dinged. And I don't know how much you've got in IRAs or 401ks that you need to take RMDs from, but if it's a significant amount, you could go into a new tax bracket. And then if you don't withhold enough or pay your quarterly taxes every year, then you get dinged penalties come April when you file taxes or October, whenever you file. So be careful not to under withhold. But what I like to do with most of my clients is make the money all year and use it for your little Christmas bonus. but withhold enough, or if you take them on a monthly basis, don't withhold anything all year. But on the last one, take a little Christmas bonus, pay your taxes, and have more withholdings. For example, I have some people that'll do a quarterly payment, but the one in December is 100% withholdings. As long as you have enough withholdings for the year, then you don't have to pay quarterlies. But some people take monthlies and they just say, oh, I'll just withhold 20%. Well, that's 20% of your money that didn't get to grow all year long, assuming that there is growth. Generally there is, especially if you're taking IRA money out of something that generates income and has principal protection, then you're going to always have growth. So I would say, look at your overall plan, find out where your taxes are. Don't let the IRS use your money longer than they have to legally. And there are some withdrawal tricks that you can use rather than withholding on each check. If you want to take more distributions and just one at the end of the year for Christmas money and your tax bill, then that's fine. Some of my clients use their RMDs strictly for tax bill, so they don't have any withholdings on Social Security and any of their other stuff. They just wait till the end of December to do the withholding. The IRS is here and go like, hey, well, that bucks our system. We want quarterly so we can keep using all that money. Well, guess what? They don't have a right to your money. They have a right to instill their rules if they want to, but we're playing by the rules. If we do it through withholdings at the end of the year one time rather than quarterly throughout the year and let them use your money all year. I just don't like the IRS enough to let them use my money all year.
520-780-9059 is our number. And John, we appreciate that question and listening to us in Dove Mountain. Okay, Jeff, Mike is listening to us in Catalina Foothills. And Mike says, I'm 75, single, and have about $3 million in equities and real estate holdings, including my house. With inheritance and estate taxes looming, should high net worth individuals reconsider how much they save versus how much they spend or gift during their lifetimes?
Depending on what your equities are in, if you bought Apple 20 years ago and you got $1 million in real estate and $2 million in one stock that has a huge capital gain, if you sell it, if you die, both those things get a step up in basis, and you're not high net worth enough to have an estate tax problem or an inheritance tax problem, not in Arizona. Back in the day when estate taxes started $1 million was a problem situation. Now, if you're married, you're single. Now you've got almost $15 million that you can pass on without an inheritance or an estate tax. So unless you're a super good investor or buying the next Apple while it's a penny stock, maybe in the next 20, 25 years, it's worth 15 or 20 or $30 million. Maybe then you have an estate tax problem. But I'm guessing that you're probably spending down some of that. Your real estate's probably generating some rent. But the good news is on most of this, unless some is an IRA or tax deferred, you're not going to be leaving a big tax problem. However, if you are as a high net worth, meaning maybe high income, depending on your income, you might be in more of a tax problem on your regular income. You might want to curb that if some of that $3 million is in tax deferred accounts that you're now having to start taking out with required minimum distributions. And that as you get older, they're going to get bigger and bigger. You may be pushed into a higher tax bracket depending on what other sources of income you have. So looking at your overall picture might help you save some taxes now and be able to position those assets that they get a step up in basis, and no one has to pay taxes when you die on any of your money if you do it right. You can do that through Roth conversions. You can still do some tax planning now, pay the taxes so that those taxes don't have to be paid in the future at a higher amount.
Jeff, I think looking at Mike's question here, another thing, if I read between the lines that he's asking, is about spending the money versus passing it on to somebody. How do you feel about that when people are his age, they're 75, they haven't spent any money at all on themselves, they want to just pass it on to the next generation? Do people have problems just treating themselves?
Sometimes they do. Some of my highest net worth people got there without really the high income jobs just because they've been really good at saving and really good at underspending, but I don't know that they've had a whole lot of fun in their life. And maybe they ought to try a trip to Europe and ride first class, get the penthouse suite on the boat next time they go on a cruise. Enjoy it. You've worked hard for it. Enjoy it. And some people do have a hard time, I think, treating themselves. And too many people, I think, we all want the best for our kids. We all love our kids more than we love ourselves, it seems. But we love helping them. We love making their life better. We love seeing smiles on their faces and their grandkids and so forth. But you can make memories with them by spending it on them during your lifetime and not worrying about the inheritance piece. But as far as the taxes looming, that seemed to be the focus of your question. At least that's what I heard and that's what I saw. But in between the lines, like you said,
right.
Is it okay to spend versus gift during your lifetime? It depends. Are your kids in a place where they could use it now? Or do you think they'll be in a place where they could use it later for retirement? And if that's the case, maybe you wait. Maybe you balance it between gifting now, spending now, and leaving a legacy. But the other thing is, if you overgift, you have to be careful on what if you get some serious illness on your final years and have to, heaven forbid, go into a facility and you live there 8 or 10 years. Nobody wants to, but that's a reality that could happen, and that could be very expensive. So you don't want to probably give away all your money, all your millions in equities and real estate, but do a balance where you still have enough net worth that no matter how long those final expenses might take to spend, that you'll have enough to spend on those things. Your home equity is a real asset. You can eventually spend that if you want to by selling your house, downsizing, reverse mortgaging it, or whatever, or a home equity line of credit. That is an asset that you could tap into if you want to. Of course, you leave a little less net assets for your heirs. But then again, you want to set up your retirement plan so it takes care of you. I would say first priority. Too many people put their kids as a first priority and end up not enjoying the life they've created or the savings that they've amassed. And I think it's sad to see that they're not able to enjoy it and have a little peace of mind about spending it. And that's one of the things that we do, I think, in our retirement plans that makes people a lot more comfortable why they like it here is the retirement plan will show what happens because, it's basically spreadsheet based. And if you make some changes, say, hey, well, what if I buy a boat or an RV this year? What if I take my kids to Disneyland and spend $100,000 on kids and grandkids and spend a month out there and just totally blow through a bunch of money? How is that going to affect my future? And you can see how spending money now affects based on certain assumptions, based on the future income, future assets, and so forth. What it typically does is allows people to see that, hey, if I just toggle up my expenditures and allow myself to spend money, it really doesn't reduce my net worth long term. In fact, I might give my kids a little bit less than I was going to give them, but I get to live a life and still give them a sizable amount of assets in 20 or 30 years from now. So don't discount the idea of looking into the future and projecting the future rather than just living on, oh, well, I don't know what's going to happen this year, so I've just got to be a miser with my money, not have any fun, and make sure I'm good to go next year. Well, 10 years from now, you might say, gosh, I no longer have 3 million, I have 6 million, and boy, I haven't had any fun, and now I'm 85 and I'm not in a position to travel and do fun stuff, and well, I missed my opportunity. I missed my go-go years. Expect to spend money in your go-go years. Expect to grow those assets back in your no-go years. That's what usually happens. So I hope that answers your question, but spend or gift during your lifetime. Everybody's got a different set of rules. You've got different values. Whatever makes you happy is what makes you happy. And I don't know what that is until we get through it and kind of discuss it. And when you look at it on an income plan, you might find out that you can be a little bit less miserly or less restrictive to your own self, and that you can have the best of both worlds and have more confidence doing it.
And we see people on both ends of the spectrum, Jeff. I mean, there are some people who want to pass along everything to their kids. There are others who say, I want my last check to bounce. It just all depends on what is the right situation for you. Talking with Jeff Vogan here, Premier Retirement Planning and Wealth Management here in Tucson. 520-780-9059 is our number. If you'd like to get in, sit down and talk with Jeff, no cost, no obligation. 520-780-9059, and you can make that call right now. Jeff, in the last part of our show here, I'm going to talk about retirement mistakes that people may regret forever and how to avoid them. The first one I want to talk about is borrowing against your home. A lot of retirees are house rich and cash poor. How should they tap equity, or should they tap equity?
Well, you saved it, you bought it. It is equity. It is an asset. I have no problem with people spending equity in their house. In fact, we encourage it for some who have everything in their house, especially people without kids. Why don't you just reverse mortgage the heck out of your house? Get all the money you can from a bank. If it is a place you want to retire in and live in and die in, then there's no problem loading it up with a mortgage. Reverse mortgage, the cool thing about that is you don't have to make a payment. And so, if you're not worried about making your kids rich, or if you've spent basically all your money except for what's in your house on their education so they could be doctors, lawyers, and really rich kids and be able to take care of themselves, then I don't think it's incumbent on you to have to leave them a big house or a big estate and leave them everything else that you've basically already given them. So live on your equity. I have a client that has reverse mortgaged her house. Every time they raise the limit on what she can borrow, she does a refi. She doesn't even care about the fees and the points and all that stuff that are basically insurance to the banks that offer these reverse mortgages, so that if your house isn't worth when you die what it was when you borrowed against it, there's some insurance and some protection for the banks. But she doesn't care about the fee. She just says, hey, I get more money I can spend. It's in my house. Now I don't have to spend my stock and bond money. I don't have to spend my other money. I can leave that liquid and it can be there for me, if I need to go on trips and do fun stuff. But that's just an option. You can also do a HELOC, which is easier to borrow money maybe than sell stock and pay a big tax on it. Some people say, well, gosh, I can always sell this stuff. Now, if you're going to a nursing home or you're going to get some medical care and stuff, and typically that's going to be a tax write-off, that's when it makes total sense to sell an appreciated asset that might have a tax associated with it, and then get that associated tax write-off for being able to itemize on your tax deductions because of some healthcare issues and so forth. So again, having an advisor to walk you through that is probably smart. We do kind of look at the tax ramifications of everything we do. We aren't CPAs and tax attorneys, but we do know how the tax code works, and we do know what you're going to be paying tax on. And we can, with a simple calculator, do the math and say what damage you're going to be caused by not paying taxes now and maybe borrowing the equity out of your house, which is tax-free, by the way, because a loan does not generate a 1099. You don't have to pay taxes on it. You get to use it. And when you die, it all reconciles. It just gets offset on the sale of your home. So let's say you borrow $200,000. You don't pay any interest on it. It grows to $400,000 balance, but your $1 million house grows to $2 million during the same period of time. Both of them double. Well, now you've got a $4 million loan against a $2 million house. There's still $1.6 million in equity. Well, what did you have when you started? You had a paid off house worth $1 million. So you only had $1 million in equity. So even with doing a HELOC or a reverse mortgage or something that generates income for you or peace of mind for you or lets you access some of the equity that you've basically already spent money on, it's like your house should be treated like a bank. That's your money. You should be able to use it if you want to. And if you can borrow from yourself and still get the appreciation in your house and have it continue to grow, then all the better. And, that's kind of similar to LERPs. I don't want to jump ship now, but that very similar situation is you borrow against your future death benefit. And when you die, it all reconciles. In the meantime, you make more money on your bank than you do on the loans you take that aren't taxable, never show up in your tax return, never create an uptick in your IRMA. That's the Medicare premiums that you pay. And, you just get through life a little easier without as big a tax bill as you could otherwise have. Why have all your money in a tax-free account, basically in an equity in your home that you could use tax-free, but you never use it, and then you just pass it on tax-free? Well, there was a lot of tax-free. Instead, you pay taxes on a whole bunch of other income because you keep making income on other stuff, or you sell something you could have made income and you paid 20 or 30% in taxes to get out of it, to pay off a bill or to go on a trip or do something. You're out 30% of the money, whereas you wouldn't be out any of the money at all. You get a step-up basis with no taxes on those other assets if you didn't have to sell them, but instead used equity in your home or loans from LERPs and other asset-based plans that never show up on your tax returns. We like those much better than taxable assets.
So these could be mistakes, but maybe not. Jeff, the next one is about the stock market and avoiding the stock market. Some people just do not trust the market. Do you think that that is a big mistake?
Not necessarily. If you don't trust the market, don't lose sleep over it. Don't make your gut hurt because you don't trust the market. I don't trust the market either. It's caught me by surprise too many times, and the market does what it does when it wants to do it, and it doesn't necessarily do it on your terms. So the market's ruthless. And while it's a place you can make money, and if you have the stomach to risk some of it or a responsible amount of it, I don't have a problem doing that in the market as long as your bills are paid, your peace of mind accounts are taking care of the peace of mind business. But I wouldn't put peace of mind money or confidence in retirement money in the stock market because there shouldn't be confidence in the stock market unless you aren't ever planning to touch it. You want it to grow for decades. And generally speaking, after a decade or two, it's worth more. Now, we can take into exception the fact that there was a lost decade, the decade between 2000 and 2010, which had 2 market crashes. We could go into another decade like that coming up ahead of us. We don't know. But the market was flat. All the indexes were basically roughly where they started in 2000, even in 2010. In fact, most of the indexes took till 2014 or 15 before they actually got back up to where they were. The NASDAQ took 14 years to get actually back to even. The Dow and the S&P are the ones that actually got back to even in the 10-year period. So again, if you had assets all over the place, you probably weren't even back to even in the 10 years, even though the Dow and the S&P, which are the most widely used indexes, looked like it was a lost decade, meaning flat. If you had assets in other areas that aren't in those 2 indexes, like the Qs, the NASDAQ, you probably were still underwater for another few years. So if you don't have a long-term time horizon, don't be in the stock market. If you are planning on using some of this upside in the stock market to give you an adrenaline rush in the morning, don't give yourself an adrenaline rush that could put you out of business and make you have to go back to work or make you have to tap other assets to live on because you had too much at risk and someday something happens that makes you regret it. So again, you can't bet everything on the farm. You got to be diversified. You got to have some safe money. You've got to have some income producing assets. You have to have insured, secured, principal protected assets. You have to have tax efficient assets. And then you can have the market money, which is not always tax efficient. It gives you good upside, but it can also give you some good downside. And like I said earlier, you have to go into the market with respect. You can't go in loosely or half-cocked. You've got to be ready for what it can dish out. I've been doing this 35 years. We've had some crashes that have burned us a little bit. So we just have to make sure it doesn't burn our whole retirement up. It just burns a piece of our assets that we're willing to wait on or that we can afford to not think about or not let us get hurt too bad from.
Talking with Jeff Vogan of Premier Retirement Planning and Wealth Management here in Tucson. Our phone number, 520-780-9059. If you'd like to get in on the conversation, no cost, no obligation for that. Next retirement mistake that people may regret forever, Jeff, and that is underestimating the need for long-term care or long-term care cost. Can that devastate a portfolio?
I think it can if you're in kind of a lower income or lower net worth bracket. I think most people have enough equity in their house when they're retired, probably to cover a long-term care visit if they needed. People downsize. Maybe somebody has a long-term care policy that they paid for. Sometimes those long-term care policies, the pay-as-you-go policies, unfortunately, the companies have been raising rates so bad that a lot of people have been having to make decisions, hard decisions, to drop them. And so I'm not really crazy about the long-term care, the typical long-term care premium type insurance. I do like what we call asset-based long-term care planning, and I think your home is one of those assets you can use. We also like LERPs. That's a life insurance version. Earlier caller had a question about I've got $350 in life insurance. Well, hopefully that's his little storage for his heirs if he doesn't need it for long-term care. But generally speaking, those death benefits are available as an accelerated benefit. In other words, you could actually spend a big portion, maybe even up to 90% of your death benefit while you are living for those long-term care type expenses or a chronic illness or a terminal illness type of an expense. So if you're using a LRP, maybe you have a really large LRP that's generating tens of thousands of dollars a year in tax-free income, but there's always going to be a balance of a few $100,000, and maybe the LRP's on one spouse. Well, that spouse can always use that money for their long-term care, and then the remaining spouse or the surviving spouse could use whatever's left in the house for their long-term care plan. So you don't need a pay-as-you-go long-term care policy necessarily. In fact, I think in most cases, they're probably a waste of money because most people, at least most people nowadays that I deal with, are probably in a position to pay for long-term care through an asset-based plan. The thing I don't like about long-term care is people have these 3, 5 lifetime plans that are going to pay for all their fees forever, yet only about 10% of the people that go to long-term care facilities even stay more than a year. Some stay a lot longer. So you have to have something that would carry you. But I just don't think the pay-as-you-go policies that you've only got about a 50-50 chance of using in the first place, and you have a much less than that percent chance that you'll use all of the benefit up that you've paid for. So I think insurance companies love that a lot more. The people that sell them love them a lot more. I think the commissions and the fees and the profits in them are probably better for the companies and the agents that sell them than they are the people that buy them and hold them. Now, given that, you're always going to be really happy that you had it if you need it. But if you don't need it, you're just wasting your money. So is there a better way? Well, I think the asset-based solutions offset that and can still create the same peace of mind and know that you have a plan that if you need it, it's there. And if you don't need it, all your money and all those premiums you saved go to your heirs.
Jeff, final mistake that people may make that might be a problem in retirement is neglecting estate planning. Why is estate planning so critical, even for modest estates?
Well, I think the probate's the biggest one. Most people think if you have a will, you don't go through probate, and that's not true. And the thing is you don't have to do an elaborate estate plan. You don't have to have a trust. You don't have to have a lot of those things that many rich people buy to make sure the lawyer's looking over your shoulder, making sure it doesn't go through probate. You don't have to pay taxes and things. If you're in an estate tax situation, a living trust might be the way to avoid probate and to get you out of some taxes. It might also be a way to you really focus the attention on one trustee or somebody that you trust to take over things when you pass away. But there are easier ways to do it. If you just want to put a beneficiary listing on every asset you own, including your house. In Arizona, you can do that in your house, and there's about 12 other states that allow you to do that. You can actually record a beneficiary deed, so your house doesn't even go through probate. The beneficiaries just go there, list it, sell it, and it's re-recorded in their name and do whatever they want with it. A beneficiary listing on an IRA or an annuity or a life insurance product or even a POD, which is called pay on death account on a bank or a brokerage firm account, or basically anything would have some sort of a beneficiary designation. And sometimes the agent or the person that sells it to you don't tell you about the beneficiaries because they're not really savvy about estate planning, don't realize that you're going to get in a world of hurt and a big mess if the court oversees the distribution of your assets and lawyers get involved because they all want $400 an hour or more. And your estate gets locked up in probate for years sometimes, and the fees just whittle it away. So you give less to your heirs. So you want to give everything to your heirs with the least amount of tax trouble and problem. Either a living trust, beneficiary designations, and the things that you can do are fairly simple, especially if you don't have a real high-end estate. Now, if you have a real high-end estate and you need to save estate taxes, you might want to do some irrevocable trust, some pre-gifting, some what we call estate freezing, and even charitable remainder type stuff if you want to really take advantage of the tax code. But that's probably for people that, anticipate having an estate of 20 or 30 million or more. If you think you're going to have a few million in your estate and you're going to spend some of the growth on it to enjoy an exciting retirement, you probably don't need to worry about the more elaborate estate plans. Now, I will say, when it comes to estate planning, some people think only of the death part. What happens when I die? There is what's called living probate, and that is when you get sick and can't take care of your own bills and stuff. What happens then? Do you have to go through a court process and get conservatorship, or do you have a power of attorney? Do you have living wills, and do you have things that basically tell the doctor if you're brain dead whether to unplug you or to let you linger on life support? You have powers of attorney so that your wife or family member, somebody that you trust, can pay your bills or to make decisions with the doctor on your health care and things like that. So even if you don't do the trust, but you do beneficiary deeds on everything, make sure you have those ancillary documents that typically trusts will include. But people that don't get trust forget to ask for those essential documents. That's powers of attorney, durable powers of attorney for healthcare, for finance, living wills, and even a backup will just in case you forget something and somebody has to argue about a distribution in court. A will does also state to the court on a form that you hope you don't have to use, but it's better to have and not need than need and not have, is to have a will as a backup that hopefully doesn't ever get to court because, of course, the fees and stuff will whittle it down. But if there is something that either doesn't have a beneficiary or somehow they need some sort of a probate action on, it's good to at least have your beneficiaries listed in a will and the succession of who's in charge and who's going to oversee that distribution listed as well. And it would probably be one of those people that you have as a beneficiary anyway, or one of the persons that you would have put on your trust as a trustee.
Jeff, out of time for this week. I want to thank you for your time, but most importantly, I want to thank our great listeners for joining us here in the greater Tucson area. So for Jeff Vogan, I'm Jeff Shade. Have a great weekend. We'll talk to you again next week right here with another edition of Premier Retirement on 790 KNST, Tucson's most stimulating talk.
Investment advisory services provided through Premier Wealth Advisors, LLC, an Arizona state-registered investment advisor. Securities transactions are placed through TD Ameritrade. Insurance and annuity products are offered through Premier Advantage, Inc., DBA Premier Retirement Planning and Wealth Management. Investing involves risk, including the potential loss of principal. Any reference to protection, safety, or lifetime income generally refer to fixed insurance products. Insurance guarantees are backed by the financial strength and claims paying abilities of the insurance carrier. The show is intended for informational purposes only and is not to be construed as advice or recommendations. Due to show format, accuracy, and completeness cannot be guaranteed. Premier Retirement and its representatives do not provide legal or tax advice and may only conduct business with residents of states and jurisdictions where they're properly registered.